Markets take a quiet day, but nevertheless, we do have data that is telling us that things are not so healthy under the hood. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And we're going to go through some of the tidbits in economic data that's come out so far this week and coming up ahead of us here in the next 24 hours that suggest we could be inching deeper along the path toward global recession. Try to figure out what is happening here and what that means for the markets. And we'll start with some of the data that's come out here over the weekend, as well as over the past day or two since the start of the week. And from there, consider what may be next. And we begin with a look at China, where just over the course of the past day, we've had an update on manufacturing data, and you can see here with the naked eye what seems to be going on. We're looking at a steep run lower, and of course, most importantly, the reading here now firmly below this 50 boom-bust level, as ever in the logic of PMIs. 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what you find here is that Chinese manufacturing activity is here at the weakest in 8 months. It gets worse. The situation seems to be primarily driven by a drop in export orders. Now, one would think we are in the middle of a trade war. Surely this is about what you would expect. But of course, we've had a much more supportive view recently, and things have held up quite a bit better around front-running ahead of the tariffs that the Trump administration threatened to implement as it was campaigning into November's election in the U.S. And since then, of course, we've seen kind of the volleys of implementation hit the markets. And in anticipation of that implementation, really since the beginning of the year, we've seen a great deal of front-running where businesses in the U.S. have really tried to build up inventories of all things that were likely to get hit by the tariffs. And of course, anything coming out of China falls into that category. And to try to squeeze that in, to build those inventories as much as possible before the levies. At the beginning of the year, it was unclear what they would be or how this would all go, but whatever levies would come, that there was a desire to sort of stock up at the lower rates before those things hit. Now, looking at these numbers here, it looks like that front-running has run its course. We get a similar sort of view from official Chinese PMI numbers over the weekend. Much like the U.S., China has two sets of PMI numbers, and we'll look at both here as well as both for the U.S. because we've got an update there as well. And we can see for the official numbers here, another month of contraction for manufacturing. But on these numbers, things are steadier, not quite as dramatic as what we see here. Here, the drop-off clearly looks like a shift lower out of what was increasingly a stabilizing range. But the upshot is about the same, which is to say that China's economy has basically failed to do much of anything for the better part of 2 years. And that continues here. The composite index at 50.4 on the official numbers from the China Federation of Logistics and Purchasing. That's in conjunction with official statisticians at NBS, the National Bureau of Statistics. Here we see basically flatlined, and flatlined for a second consecutive month here. So the overall story is the world's second largest economy is basically going nowhere. The larger issue, though, is that what we're looking at now looks like even the slight bit of a pop in manufacturing demand, saw that right here, around front running of these tariffs has now given way and seems to be unraveling. On the U.S. side of things, we get the PMI numbers from the Institute of Supply Management. Here we get a third consecutive month of contraction in the manufacturing sector. Again, we can see it's had a little bit of a pop earlier, ever so slightly, but we continue to see contraction here, and the internals are hardly encouraging. Employment still below 50, continues to contract. New orders still below 50, continues to contract. A little bit of a stabilizing on this crazy jump in the price index, so perhaps a little bit of an anchoring here, but of course, this is at extremely high levels relative to history. And when we start going through this by sub-components, this handy table from ISM really helps to visualize what's occurring. So here's the overall manufacturing PMI. We can see it deteriorated from April into May. It's contracting at a faster rate, and the contraction trend has been running for 3 months. New orders have been falling for 4 months. Overall production falling for 3 months. Employment falling for 4 months. Supplier deliveries, 6 months. Inventories are contracting now. They had been surging. That, of course, makes sense. That's that front running of tariffs, so it does look like there's a little bit of a pull on this from some amount of demand. That's perhaps a little bit of a sense here. But the trend in prices for 8 consecutive months, we've seen prices surge, and of course at these very elevated levels. The backlog of orders continues to contract. That's not great news on demand. New export orders sinking. And sinking at a faster rate. You can see the delta on this change here, quite dramatic. 3 index points. So the overall story from both sides of the most crucial supply chain, the U.S.-China leg of global commercial linkages, showing that front running of the tariffs seems to be running out of steam or has already petered out. And of course, this then raises the most important question of all. Now, we've seen that businesses have attempted to fill up inventories because tariffs are coming. That much is clear. We can take a glance here as we're talking about this back at the first quarter GDP numbers, and we can see clear as day here. Here's the surge in investment powered by stocking up of those inventories. Here's a blistering jump in imports that tells that story. So very clearly here, we can see this is what's going on. But the larger question is, of course, who is going to come buy this stuff? because this becomes then a two-pronged issue if nobody comes, or at least if uptake is slow, as we seem to be seeing in April's retail sales data. If we are not going to have happy consumers come and buy this stuff out of inventory, then first, there is the issue of companies don't need to buy as much downwind. And that, of course, is a slowdown in economic activity. So this kind of surge to GDP from investment, that's not going to happen going forward as a driver of demand if inventories are not pulled lower in a meaningful way. Now, we can see here again, now they're contracting, so perhaps we're starting to see some of this. It's only 1 month's worth for now, but if the pace of uptake is not meaningful, well, then businesses are going to get stuck sitting on these inventories, and they're not going to be out there buying more and stocking up more. The first issue then is, of course, the hit to overall economic activity, but the second one is to the financial stability of those businesses, because they've now bought themselves, assuming weak uptake, a largely non-performing asset, an inventory that isn't getting turned over fast enough to make the business's costs and profits balance make sense. So as we look at all of this, we then focus on what are consumers actually doing. And this is where looking at the driver of consumption demand really becomes very interesting. And we can see here the S&P global version of these PMIs, which incidentally was revised today on the manufacturing side and revised a little bit lower. It does show you a little bit of a better view here. Manufacturing for May is expanding, albeit at a slower pace than initially reported. That very clearly seems to be the last gasp of this front running that we're talking about. We can see restocking is by far the strongest impulse of the subcomponents here. But the sort of main takeaway is that manufacturing has been anemic for quite some time. It's services that's been powering the U.S. economy. And whereas China, as we just saw, has been basically flatlined, the U.S. has actually had quite robust economic growth until the beginning of this year. It's really in January that things started to trend aggressively towards standstill. For much of the second half of last year, growth in the U.S. was quite strong. In fact, the strongest since essentially late 2021, early 2022. And you can see it's services powering that, and most service demand in the U.S. is serviced domestically, no pun intended. And so with that in mind, this really becomes the gauge of what the consumer is doing. You can see it in spades looking at the latest CPI data, and really CPI data over the past several years, where we can see that the overwhelming majority of the price impulse in the data is in core services, whereas goods demand is barely existent. Food and energy are relatively steady in terms of their contributions, but this is really where all of the demand is. Of the core CPI in April of 2.8%, 2.2 almost percentage points is services. So with that in mind, we look at what'll be the next big data point in this sequence, and that is the ISM service sector index, the expectation here in the red that we are going to get a little bit of an uptick up to 52. That'll be a slight improvement over the 51.6 that we saw in April, and a second consecutive month of improvement if we continue to go in this direction. And that'll be sort of the barometer on what the consumer is actually doing, because going back to the GDP numbers here, we can see all of this tariff front running aside, consumption was the weakest it has been since the second quarter of 2023, so almost 2 years. And consumption is really what matters. It is 68.5, give or take, percent of GDP. Everything else is kind of an afterthought. So if we really want to see what's going on here, this is the part of the equation that matters. And we can already see the fragility. The composite index for the world economy as of April was at its weakest in 17 months, going back here to early 20 or late 2023, right here. So over a year. And what we're seeing then is a global economy that, with the deceleration in the US, is starting to decelerate more broadly. And of course, since the global economy, as we've said a lot of times here on the show, is mainly made up of three economies generating demand and the remainder acting basically as vendors to the former three, what happens in these three really is critical. Now, we just saw China is at standstill. The U.S. has basically ground back toward standstill. We can see that here. There's this little bit of a pop more recently, but if we take a look at the way that this might work out here now, with manufacturing going into a deeper slump and maybe an uptick, slight uptick in services, perhaps the center line to all of this, since services is a bigger part of the economy, is something along the lines of about 50, give or take, on what would be a composite, a weighted composite, so near standstill on the U.S. economy. And since we'd be remiss to skip the Eurozone, which is another big part of this equation, we can see that for the Eurozone, not only are we through standstill, but we're actually having that economy fully in contraction mode, both manufacturing and services now posting sub 50 readings, and the composite likewise, of course, by extension. So all of this now looking like contraction. Then the question becomes, well, just how far away are you from a global recession? If this is the whole of the world economy, and the trend in China is doing this, and in the best case is just stuck, depending on which version you look at. And if the version in the Eurozone is doing this, is to say it is already in contraction mode, well, then what you're left with is this, the US, and there it seems like the story is increasingly, assuming these expectations hold, flatline. And if that's the case, well, then where is growth supposed to come from? And the upshot seems to be, if this continues to develop as we're looking, well, then a global recession becomes essentially inescapable. There's just nowhere else to go. And so despite the fact that we're still seeing stocks hovering at meaningfully elevated levels, we still don't have a level of runaway panic in the markets, although the dollar has certainly shown quite a bit of weakness, and that weakness has been really relentless since the beginning of the year, despite sort of corrections in other markets. As we look at all of this, and the S&P is hovering near the peaks it set back mid-May, which were the highest levels since late February, early March, despite the sort of supposed and would-be optimism that's showing up on Wall Street, the architecture of what's going on is increasingly troubling. And as more and more data comes in to paint that picture, it seems a matter of time and not a matter of direction for when the markets begin to seriously wonder what all of this means for earnings, how all of this probably means lower rates and higher bonds, how the dollar is probably not done falling as the screaming out from markets for the Fed to cut rates despite its resistance grows louder, and how gold may continue to power upward against the backdrop shaping up. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be on with Victor Jones for the Price of Truth tomorrow. Chris will be there today, so definitely check that out. I'll be back with Chris for Futures Power Hour on Friday. Back with Victor and Tom for First Call on Sunday, writing for the news and insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.